This reporting period has witnessed the eagerly anticipated global vaccine rollout, beginning with the UK leading the way within G7 economies. The early evidence suggests that the vaccine is highly effective in reducing infection rates and severity. Countries with high vaccination rates, such as Israel and the UK, have been able to scale back restrictions without a further wave of infections, whilst economies yet to introduce effective vaccination programs, such as the EU, have seen further waves of infections and lockdowns. The vaccine success has boosted equity markets but caused bond markets to move lower due to inflation concerns being triggered by the prospect of a globally synchronized rebound in economic activity, causing a surge in demand. Reflecting on the year 2020, investors holding the average medium risk portfolio, measured by the Investment Association Mixed Investment 40 to 85% shares sector, would have seen a return of over 5%, belying the significant swings during the period. At the worst point, this sector recorded a loss of nearly 20% before making a full recovery. With equity markets having achieved the perfect V-shaped recovery, economic growth is also rebounding, with China already ahead of pre-COVID levels of economic output. The UK is predicted to achieve this by the end of 2021, with growth expected to hit the highest level since 1941. During the early stages of the pandemic, there was a shortage of personal protective equipment, and various hoarding strategies were employed by countries to ensure their needs were prioritised before production rose to meet demand. Similarly, base materials for COVID-19 testing also experienced acute supply difficulties before global production rose to meet the high levels of demand. The same pattern is now occurring in relation to vaccines. However, the number of vaccines approved for use is growing and production is also increasing, so we expect this shortage will also be temporary. Economies currently leading global vaccination efforts have been able to remove restrictions sooner and benefit from an earlier economic recovery. As vaccine manufacturing and deployment accelerate, the recovery will broaden. The risk of variants is also believed to be manageable. As vaccine technology has demonstrated, it can be refined and modified quickly and effectively as needed. During the pandemic, global banks and governments have injected huge quantities of cash to protect the economy from collapse. In the UK, this has included cheap loans, paying wages of furloughed workers, grants, and extending the purchase of government bonds by the Bank of England. Notably, consumer savings increased during 2020, as many workers maintained their income but were unable to spend as usual due to economic restrictions. As investors begin to look forward to a post-COVID environment, concerns about inflation are beginning to increase. There are already signs of inflation due to base effect, the distortion caused by abnormally low levels of inflation 1 year ago, as the price of base goods fell dramatically during the first lockdowns. For example, last year oil prices briefly turned negative on some exchanges as pipeline deliveries overwhelmed demand, leading to shortages of storage. Prices have now rebounded, causing inflation measures to jump upwards. The triangular relationship between inflation, yields, and growth stocks has caused a recent spike in market volatility. The elements have worked together positively since the credit crisis to create a steady increase in the value of bonds and growth equities, with the US market being the key beneficiary due to the high prevalence of growth and technology companies. COVID-19 added a further leg to this trend due to the upswing in the virtual economy caused by lockdowns and further stimulus. It is now worthwhile considering the effects of these trends beginning to unwind. The notable area of vulnerability to a change in a long-term trend are index tracking strategies. Those strategies with an allocation to government bonds are particularly vulnerable as government borrowing has increased since the credit crisis and into COVID-19. Governments have been issuing longer and longer dated debt, keen to lock in historically low borrowing costs for as long as possible. This has skewed the market towards more interest rate sensitive holdings and, of course, tracking funds are obliged to follow the market. This outlook will lead to clear winners and losers, with some expensive growth stocks potentially vulnerable to higher future borrowing costs, even though they may continue to grow revenues. So we also expect lower average returns from global assets over the next decade, with higher levels of volatility. A full PDF commentary for this quarter is available on the KLO website.